Hello friends, this is Dr. Sunil Kadam. Welcomes you to my channel Let's Learn Accountancy with Dr. Sunil Kadam. On this channel, I will be uploading videos on various topics of accountancy. I hope you will enjoy these videos. Friends, today's video for those students who are in a TY BCom in the University of Mumbai and having financial accounting subject for their TY BCom. And as you know, due to the pandemic, universities are conducting their final exams on MCQ modes. So let us help them by having some discussions on MCQs of the first chapter of that subject, preparation of final accounts of a company. And in this video I will be explaining or discussing with you the MCQs which are based on a theoretically. There won't be any numerical. For numerical MCQs I will be preparing one more video, and you should go through that also. So friends, let's start discussing the theoretical MCQs of preparation of final accounts of a company. The first objective is the requirement of final accounts of a company are specified in the schedule dash dash of a Company Act 2013, and the options are 1. Schedule 1, option 2, Schedule 2, option 3, Schedule 3, and option 4, Schedule 6. Friends, for every MCQ there will be 4 options, and you have to choose the appropriate. That will definitely get you full marks for that, and it depends upon the what mark is allocated to this. So as far as this objective is concerned, so we need to understand that the Company Act 2013 has given total 7 schedules along with the Company Act, the amended Company Act I'm talking about, which is amended in 2013, and they had given us 7 schedules along with that, and out of that 7, the third schedule talks about how to the specimen or the format of is provided in that schedule, how to prepare the final accounts of a company consisting the profit and loss account and a balance sheet. Balance sheet is a part 1 and a profit and loss account is a part 2. Therefore the correct answer for this option would be or is the schedule 3. So friends, wherever the color is changed for the option is the correct answer. So correct answer is third. Why the schedule 1 is talk about memorandum and article of that company, whereas the second is for depreciation, third for that's what we have already discussed, fourth for code of independent directors, and fifth for appointment of a managing director, and sixth is for infrastructural project, and seventh is for social corporate social responsibility, CSR. So there is a possibility questions may be asked in a different manner. Here we had talked about only one, that is third schedule, but they can ask in a different manner. In some MCQs they may ask which schedule is for say CSR in amended Company Act. At that time your answer should be number 7, right? So hope you understood it. Let's move on to the next objective and discuss in detail. The objective number 2, any amount payable within 12 months from the date of balance sheet is called as option A, capital, loan, contingent liability, and current liability. any amount payable within 12 months from the date of balance sheet is called as a current liability, because the dues which is paid within 12 months from the date of balance sheet is called as a current liability, which is, and those who are not paid within 12 months is called as a non-current liabilities. And the other options which we have here is a capital. Capital is a sum invested in the business, and which will be for a longer period, not for 12 months. Loan is taken from the bank or any financial institute, which will be repaid but not within 12 months, along with the principal plus interest has to be paid. But the contingent liability is a liability which may occur, may not, that can guarantee right now, but it depends upon the uncertain future or future events. If it has happened, then it will be liability. It may not happen, it won't be liability. That's why there is no surety about it will pay within 12 months. Hence, the correct option for this objective is current liability. Let's move on to the next objective. At the time of preparing company's balance sheet, call scenarios to be dash dash. Option 1, shown as a debtor, reduce from share capital, shown as investment, ignore. What they said, at the time of preparing company's balance sheet, call scenarios has to reduce because that much amount is not received from the shareholders. So the company, when make a call, it is called as a called up capital, and out of which unpaid calls will be reduced. So this is what a amount which is not paid by shareholders is called as a call scenarios, that is unpaid calls, and henceforth it has to be subtracted from the capital issued in subscribed capital. Let's say we knew there are several type of capitals. It's just like as a it starts with the authorized capital, then it is issued capital, then we have a subscribed capital, then called up capital. From that we reduce the unpaid calls, and it will be a paid up capital to the outer column, and that will be shown to the liability side of a balance sheet under equity and liability, under the heading of shareholders fund, the share capital, and there which we have discussed it. So answer for this option is the unpaid balance is called as a call scenarios of share capital is deducted from the कहाँ से डिडक्ट किया जाता है? At the time of preparing balance sheet, it is reduced from share capital. So let's move on to the next objective. As per the Company Act 2013, the transfer to reserve by the company is transfer to reserve. That is important, reserve. So let's find out what are the options for it. Transfer to reserve, it can be a 10%, 15%, 25%, or voluntarily. A company wants to transfer its profit to reserves. How much percentage they can transfer? 10%, 15%, 25%, or voluntarily. So the correct option for this is voluntarily. Why it is voluntarily? See, the amendment when it is carried out, they have ignored the compulsion. In old Company Act 1956, it was mandatory for every company to transfer at least 10% of their net profit. That is maximum limit, not at least. The maximum 10% they can transfer. But here they are withdrawn. They are not taken that much seriously. They are given option. You may or you may not. You can transfer any amount or no amount to the reserve. This is what a choice has given. Therefore, the option voluntarily is correct for this particular MCQ. Let's move on. Which of the following item appears on the asset side of a balance sheet? So balance sheet, the item 1, capital reserve, security premium, capital redemption reserve, sinking fund investment. Let's understand the MCQ. MCQ says that which of the following items appeared on the asset side of a balance sheet. Balance sheet asset side में जाएगा. Capital reserve. Capital reserve is generally charged to liability side under reserves and surpluses. Security premium also part of reserves and surpluses of liability side. They are asking us asset side. Therefore, the third item is capital redemption reserve, also part of reserves and surpluses. But the last item is sinking fund investment account is investment, and investment goes to the balance sheet asset side under the heading of non-current assets. And under non-current asset we have a non-current investments, and there it will be charged. Therefore, the correct option is sinking fund investment, because the remaining three options which is given for this particular MCQ are charged under the heading of reserves and surpluses. It comes under the liability side of a balance sheet. Therefore, we will be recording this sinking fund investment account to the balance sheet asset side. So let's move on to the next adjustment, objective. Number 6, the example of accounting policies is, their options are depreciation, consistency, going concern, and accrual. Out of these 4 options, 3 options are the example of accounting concepts, and 1 is example of policy. Let us talk about depreciation. Depreciation is a policy which the organization adopt, whereas the consistency is the accounting concept. Going concern also is a accounting concept, and the accrual also a accounting concept. Therefore, depreciation is the accounting policy. Therefore, the correct option for this objective is depreciation. So depreciation is a policy, consistency is the accounting concept, going concern is accounting concept, and accrual is accounting concept. So let's go for 7th objective. Unclaimed dividend given in a trial balance is shown under dash dash of the at the time of preparing company's final statement. So options are share capital, current liability, short-term provisions, long-term borrowings. Let us understand the objective once again. Unclaimed dividend given in a trial balance is shown under dash dash at the time of preparing company's financial statement. Will it be shown under the share capital, current liability, short-term provision, or long-term provisions? So unclaimed dividend, unclaimed dividend, yes, unclaimed dividend, which will be paid within say recent future, therefore it will be considered as a current liability. Share capital will pay it, but later on, it's a long term. Whereas the short term provisions, that are all the provisions, but this is not a provision. And long term borrowing, it will be paid for a longer period. Hence, the correct answer is current liability, which will be paid immediately after the balance sheet. Therefore, shareholders which is fail to claim that dividend, that's why it is called as unclaimed dividend, and which is supposed to be paid within 30 days from the balance sheet date. Henceforth, it will be considered as a liability. If it is not claimed by that particular shareholders, then it will be transferred to a separate account. The company has to open a separate account into the scheduled bank and create one account with the called as a unpaid dividend, and all those unpaid dividends will be credited to that account. So this can be a objective. If unclaimed dividend is unclaimed dividend is not paid for a longer period, it will be transferred to dash dash account. But as far as this objective is concerned, the correct answer is current liability. I hope you understood. Let's move on. Number 8 objective is dividend is calculated on. Dividend is calculated on. Is it calculated on a paid up capital, or is it calculated on a called up capital, or is it calculated on a call scenarios, or on authorized capital? So we have to tell them on which capital it will be calculated. So dividend is normally calculated on a paid up capital, because the paid up capital is the amount which is paid by a shareholder, and what amount they have paid, on that only they deserve to get a dividend. Therefore the paid up capital. The another option is what here, called up capital, that is company demanded, but there is a possibility some shareholders may not pay the balance, the due amount, therefore they don't deserve on a called up capital. They deserve amount or dividend on the paid up capital. Call scenarios is the amount which is not paid by that shareholder, so on that there is no question of paying dividend. And authorized capital is a capital which is company got authority to issue, but it need not to be that amount will be the entire authorized capital, may be issued and called up and then paid up. So the correct option for this option MCQ is paid up capital. So paid up capital is what on which the dividend is calculated. So at the time of preparing balance sheet also, you have to ensure that if the adjustment is given, the proposed dividend is so and so, so at that time you have to calculate that dividend or proposed dividend on paid up capital. That's why, as we have already discussed, what is authorized capital, then issued capital, subscribed capital, called up capital, and paid up capital. So let's move on to the 9th objective. Following is not a contingent liability. They had given a certain liabilities here. Let's find out which are those. Interim dividend, bills discounted, liability under guarantee, and arrears of preference dividend. These are the 4 liabilities they had given, and you have to identify which one of these is not a contingent liability. It means there are 3 contingent liability, but one is not there. So now your task is to find out which one is. So let us discuss interim dividend. Interim dividend is it is supposed to be paid immediately after it is declared. Therefore interim dividend is not a contingent liability. Now let us understand what is a contingent liability. A liability which may be a liability in a future. Why it is in a future? Because in a future there is an uncertain event. If that event is happened, then it can be a liability, otherwise it will not be a liability. So let's discuss that second option, bills discounted. The bill is discounted. If the bill is dishonored, then you have to pay the liability. So there is uncertainty. That's why it is a contingent liability. If bill is discounted, but if it is honored, no need to pay any liability. But if it is dishonored, then you have to pay the liability. That's why it is contingent liability. Liability under guarantee, also a contingent liability. When you have given a guarantee, but the person who had taken a loan on your guarantee fails to repay those loan, then you need to pay the liability. That's why it is contingent liability. Arrears of preference dividend. Preference dividend, you supposed to pay it, but when company earns the profit, then only they have to pay it. Therefore it is also uncertainty. That's why these 3 liabilities are uncertain, therefore it is contingent liability. But the first item, interim dividend, you supposed to pay it. The interim dividend will be declared when the company has a profit and it is already there, and company wants to share their excess profit with their shareholders. That's why interim dividend is the correct answer for this option. So let's talk about next objective, number 10. The following is not a fixed asset. That given an example, livestock, then patent, loose tools, and machinery. Now out of these 4, One is not a fixed asset. So let's discuss that. Livestock, patents, loose tools, machinery. Which one is not a fixed asset? So let's check out first which are those fixed assets. Machinery is a fixed asset. Patent is a fixed asset, but machinery is intangible asset. Machinery is a tangible asset. Patent is intangible asset. Livestock also a fixed asset, but it is tangible asset. Now remain what? Loose tools is not a fixed asset. It is current asset, will shown under inventory. So the correct answer, the asset which is not a fixed asset among these is loose tools. So loose tools is a current asset shown under the inventory. The 11th objective is cost of construction of a building under the construction is shown under option A, miscellaneous expenditure, capital WIP, profit and loss account, share capital. So the construction which is going on but not yet finalized, where it has to be shown? Miscellaneous expenditure, capital WIP, profit and loss account, or share capital. When the construction will complete, it will be transferred to the building. That is comes under fixed asset, tangible. But up to the date of the construction is going on, it will be transferred to. We have learned in the format under the fixed asset, we got a 4 subcategories there, sub items there. Fixed asset, tangible, intangible, fixed asset which is under construction, under the work in progress, and intangible asset which is also not finished, also shown under intangible asset under construction, WIP. So the correct answer is capital WIP. And all other places where the miscellaneous expenditure it is not there is no question of showing it. It is a fictitious asset. Profit and loss account also it cannot be transferred to profit and loss account, and share capital also there is no question of child. Working capital WIP shown under the fixed asset, under tangible asset. So the correct answer, capital WIP. Number 12, maximum remuneration to a managing director in case of a profit can be a maximum limit. That is what important. 4%, 5%, 10%, or 12%. So the correct answer is here 5%, because the section 197 of Amended Company Act talks about how this limit, because there they had told that not more than 5% a company can give a profits 5% to its a managing director. They can give up to 5%. That's why the correct answer is, one can say 4 also falls within that, but in a given situation they asked maximum. So maximum 5% can be given. Let's move to the next. Final dividend can be declared by shareholders only, directors only, register of a company, NCLT. So the dividend is the share of profit given to the shareholders, and it is talking about final dividend. A final dividend, the directors has to propose it and accept it into the board meeting, and thereafter they have to present that resolution or that proposed dividend to the AGM, and AGM with a special resolution accept that. So indirectly, who has given the dividend finally? It is given by shareholders only, because director can propose it, but who has the authority to give the final dividend is shareholder. That's why the correct answer is shareholder. Director can propose it. The interim dividend can be given by your directors. They are allowed to give the interim dividend, but the final dividend. Now you should know the difference between final dividend and interim dividend. A dividend which is paid finally by looking at the exact profit is called as a final dividend. But the dividend which is paid between two final dividend is called as interim dividend, and that can be given by a board of directors. But here the answer A is correct, because the final dividends we have to discuss about. The final dividend can be declared by shareholders. Number 14 is following is an example of appropriation of a profit. Appropriation means allocation, dividing the profits, distribution of profits, allocation of profit. The example is it interest paid on loan? Is it interim dividend paid? Is it payment of audit fees or payment of employee benefit expenses? We want to find out which is the example of appropriation. Appropriation means distribution of profit. Interest paid on loan is expenditure. Payment of audit fee is the example of expenditure. Payment of employee benefit expenses is the example of expenditure. But interim dividend is paid out of the profit. That is allocation of profit or appropriation profit. Therefore the answer is interim dividend paid is example of appropriation profit. And the remaining all three are the example of expenses. Number 15 says following is not shown under short-term provision. Provision which is the provision made for paying certain expenditure. Now let us find out what are the provision for taxation, provision for dividend, provision for depreciation, and provision for unpaid salary. Among these four, there is a one example of a short-term provision. Following is not short-term provision. Three are the short-term provisions, but one is not. Now let us discuss. Provision for taxation is the provision for tax, so it will be shown under short-term provisions. Provision for dividend also paid in a short-term, so it is a short-term provision. Provision for unpaid salary also provision, but the provision for depreciation is not example of a provision. It is a provision, but it will be deducted from the fixed asset. Therefore the correct answer, which is not short-term provision, is depreciation. So depreciation will be deducted from the original cost of asset, and the outer column will be net block will be shown. Gross block minus provision for depreciation, outer column net block, and it will appear under fixed asset, and the fixed asset is shown to the asset side, and the remaining three items will be shown under short-term loan and short-term provisions, and it will be shown to the liability side under the heading of current liability, short-term provisions. 16th objective is, while preparing company's financial statement, bills receivable is shown under dash dash. Let's see what are the options. Non-current asset, current asset, non-current liability, current liability. It's a bills receivable. Now let us understand the difference between current and non-current. Current stands, the current asset stands the asset which is going to convert into cash or sold out within 12 months is current asset, and non-current which is not going to convert in a cash or sold out within going to change its nature within given operating cycle, it is non-current. But here we got an example of bills receivable, and bills receivable will be converted which will be realized within 12 months from the date of balance sheet. That's why it is a current asset. So the current liability and non-current liability is not applicable, but current asset and current non-current asset, there will be a dilemma. You may commit a mistake, but remember friends, the asset which is going to sold out or change its form within 12 months is called as current asset. So bills receivable will realize within 12 months, therefore it is current assets. 17 says for a company, property, plant and equipment PPE includes bearer plants, stock of goods, loose tools, bills receivable. PPE is plant and property, comes under fixed asset, tangible asset and fixed asset, tangible asset, fixed asset, and comes under non-current asset, fixed asset and asset, part of balance sheet. But here we got the examples of last one is a bills receivable, is just now we discussed, it is current asset. Loose tools, also example of current asset. Inventory, stock of goods, also current asset, it's an example of inventory. Bearer plants is the example of agriculture property, comes under property and equipments of an organization, because the Ind AS number 41 agricultural, it talks about the bearer plant is a biological assets of a company. Therefore bearer plant is a part of property, plant and equipment, and it will be shown under asset side, non-current asset, under which fixed asset there will be a tangible asset, and those are the plant property, plant and equipments. Number 18 is in a scheduled of fixed asset, scheduled of a fixed asset, closing depreciation equals to. How the closing depreciation is calculated? I am talking about schedule. Schedule 3, part 1, balance sheet, that given us. Okay, let's check. Opening depreciation plus depreciation depreciation provision for current year minus depreciation on assets sold out, or opening depreciation minus depreciation provision for current year plus depreciation on assets sold. Opening WDV plus depreciation provided for current year minus closing WDV. Opening WDV minus depreciation provided for current year plus closing WDV. So to understand this, the correct answer is opening depreciation plus depreciation charge for current year minus the depreciation on those assets sold out would give you the correct closing balance of depreciation. That's why the answer A is correct. Now to prove that, let me show you the format given on, in a schedule 3 part 1 as a note number 10. It's in front of you. There what it says for calculating this portion talks about the original cost of asset, opening balance of asset plus purchases of asset minus sale of asset is the closing balance of asset. From this asset the depreciation will be deducted, and calculating this depreciation we have to consider first opening balance of depreciation plus depreciation charge for current year minus the depreciation of those assets sold out, provision for depreciation of the assets sold out, so the closing depreciation. That's why it is 6 plus 7 minus 8. Opening balance plus the current year's depreciation minus the depreciation on a disposed of. So therefore the option opening balance of depreciation plus depreciation for current year minus depreciation on asset is correct. All other options are incorrect. So let's move on to the next objective. Number 19. While preparing company's balance sheet, prepaid insurance is shown under. Prepaid insurance will be shown under loan, long-term loan in advances, short-term loan in advances, short-term provisions, long-term provisions. Now we have to show, while preparing balance sheet, Prepaid insurance, insurance paid in advance, which is paid for say within 12 months, that's why it is advance. Immediately the immediate following years it will be recovered. So long term loan, it is for more than 12 months, then long term loan in advances. Short term loan in advances, it is prepaid. Short term loan in advances would be the current, because short term provisions are the expenses and long term provisions also expenditure, but it's a liability. But here it is an asset, so the answer is a short term loan and advances is the correct answer, because it will be shown under current asset under the heading of short term loan in advances, because which will be recovered or which is paid for within 12 months from the date of balance sheet. And the last objective, which of the following is shown under reserves and surpluses? Calls in arrears, no, it's shown under the shareholders fund, capital. Calls in advance, also shown to the capital. Security premium, shown to the reserves and surpluses, and bills payable under current liability. So the correct answer is security premium shows under the reserves and surpluses. Therefore all other three options is not applicable, but the security premium is the amount which is difference of normal value of security and actual paid up value of security is known as the premium, and the premium is surplus for it, and it will be shown under separate heading security premium of reserves and surpluses. That's all guys. The 20 objective which is most common objectives which can be asked in the exams of TYBCom. Thank you guys for watching this video. If you have any queries, doubt, difficulty or feedback, feel free to write in the comment section. I will answer them as soon as possible. Make sure to hit the like button if you understood the objectives explained in this video. If you would like to see more such kind of videos, don't forget to subscribe this channel. Make sure to hit the bell icon as well in order to get the notified whenever I upload a new video. Share this video with your friends in order to make them benefit out of